Alright, let's dive into why Wall Street's acting like a confused puppy right now. Picture this, it's Tuesday night, the S&P 500 futures are basically napping, and everyone's glued to their screens waiting for the Fed to drop its rate decision. But here's the twist, this isn't just about numbers on a spreadsheet. This is about the psychological chess match between investors, central bankers, and the ghost of inflation past. Personally, I think we're watching a real-time case study in market indecision, and honestly, it's more gripping than a Netflix thriller. Let's start with the obvious. Ford's stock jumps 5% after beating earnings, while Visa tanks because its guidance was about as exciting as a DMV wait. But wait, why does this matter? Because Ford's win isn't about cars. It's about old economy resilience. Meanwhile, Visa's stumble whispers, hey, maybe consumer spending's showing cracks. See the pattern? Markets aren't reacting to numbers, they're dissecting the story behind them. In my opinion, this earnings season feels like a poker game where everyone's bluffing, and the Fed's the dealer holding the wild card. Now, the Nasdaq's 5-day losing streak. That's not just bad luck. It's a bloodbath in tech, especially chips. SMH ETF down 9% in a week. That's a nuclear-level sell-off. But here's the thing, tech's pain could be value stocks' gain. If the Fed pauses rates, which traders give a 70% chance, where does the money flow? To the battered innovators? Or the safe dividend plays? What many people don't realize is that this isn't a binary bull/bear market, it's a reweighting of risk. Julia Hermann at New York Life nails it. The market's too focused on inflation bogeyman, and not enough on what tightening actually breaks. Deep stuff. And then there's the elephant in the room, Kevin Warsh's press conference. Investors are treating his words like ancient prophecy. But let's pause, why are we still so obsessed with Fed speak? Because, frankly, they've trained us to. Every pause, every micro-inflection, becomes a trading signal. This raises a deeper question, are we in a market anymore, or just a casino where the Fed's the croupier? From my perspective, the real story isn't the rate call itself, it's how this cycle is reshaping investing DNA. The hawks versus doves narrative is tired, the real battle is between data-driven policy and market psychology. So here's my closing thought, this isn't just about 2026. We're seeing the birth pangs of a new market regime. The winners? Companies that thrive in limbo, think Ford's turnaround or defensive plays like Procter & Gamble reporting tomorrow. The losers? Overvalued tech darlings who mistook easy money for genius. But what's fascinating is how this Fed decision could be the spark that reignites either a value rally or a tech renaissance. So what do you think, time to bet on the comeback kids, or play it safe while the central banks dance? Drop your take in the comments, I'm dying to hear if you're team pause or team panic.